Are you looking at a stock that is flashing a strong buy signal and trading at this massive discount? Or are you basically walking straight into a devastating value trap?
Right. That is the billion-dollar question.
It really is, and that is exactly what we are tackling today. We are doing a deep dive into America's Gold and Silver Corporation. The ticker symbol is USS.
Definitely a stock that has a lot of people talking right now.
Oh, for sure. But hey, before we get too deep into the weeds, do us a quick favor. Hit that like button, subscribe to our YouTube channel, and it is absolutely compulsory that you leave your comments and feedback down below. We really want to keep this debate going with you.
Yeah, we love seeing what you guys think in the comments.
Okay, so to set the stage for you, let's look at the latest quote from April 17th, 2026. The stock closed at $6.55.
Right.
It gained a, respectable 1.71% on the day. That's about an 11-cent bump. But if you are just looking at that daily green number, you are completely missing the hurricane that just blew through this chart.
Well, you really are. I mean, a daily close in a vacuum tells you absolutely nothing about the structural reality of a company.
Exactly.
Especially in the mining sector,
And the context here is just wild. Look at the 52-week ride. We are talking about a jaw-dropping low of $1.24, surging all the way up to a high of $10.50.
Which it hit just a few months ago, right? In January of 2026.
Yeah, exactly. And now it is sitting right in the middle of this recovery phase after just a brutal, nasty pullback in March.
And that extreme volatility, I mean, that's exactly why we are doing this deep dive. Our mission today is to really unpack the underlying financials, untangle the technical analysis, and lay out the mechanics of the bull versus bear debate.
We really want to help you understand all these massive cross-currents dragging the stock around.
Exactly. But I do need to state right up front, though, that this conversation is a natural human debate designed purely for educational purposes.
Always important to note.
Yeah. We are looking at data, we're looking at market psychology, but absolutely no financial advice is being given here.
Completely. We are just, lifting the hood to see what is smoking under there.
Well said.
So to understand if USS is genuinely undervalued or if it's just a trap waiting to spring, we first have to look at the actual money moving in and out of the company, the raw numbers.
Right. You always have to start with the cash.
Let's start with the income statement for the full year of 2025. Gross income hit $6.45 million.
Okay.
Now, on the surface, if you're just reading a press release, that sounds like a massive win. I mean, it represents a 131.6% year-over-year increase.
Triple-digit growth.
Right, triple-digit growth. And it is a really massive.
Yeah.
But here they are still reporting a staggering net loss.
Which naturally forces you to ask, how do you more than double your revenue and still bleed cash?
Okay, let's unpack this because I was looking at their expenses, and the culprit here isn't just the cost of digging holes in the ground.
It rarely is with these companies.
Yeah, it is their SG&A, selling, general, and administrative expenses. It is sitting at nearly $40 million.
Wow.
39.6 million to be exact. And we have to be really clear about what SG&A actually is for the listener.
Right, it's not physical assets.
No, that isn't capital expenditure. That isn't the physical cost of upgrading a mine or buying new drills. SG&A is corporate overhead.
Executive salaries, lawyers, that kind of thing.
Exactly. Consultants, office space. And because of that, they have a pre-tax profit margin of negative 87.3%.
Nearly negative 90%.
Yeah. It's like having a restaurant where the dining room is packed, tickets are just flying out of the kitchen, but you are still losing money every night because the corporate management team is upstairs eating up all the profit.
If we connect this to the bigger picture, that corporate burn rate is incredibly concerning when you juxtapose it with the capital they actually need to deploy into the ground.
Yeah.
To really gauge if they can survive that kind of cash burn, we have to pull back and look at the balance sheet as of December 2025.
Let's do it.
This shows us their cushion versus their burdens. Right now, they are sitting on $177.90 million in cash and short-term investments.
Which is a very solid safety net, right?
It is a big pile of cash, yes.
Right.
But, looking at a cash pile without looking at the debt is just a classic rookie mistake.
Oh, absolutely.
Precisely. You have to measure it against the liabilities. Their total debt is reported at $81.3 million.
Okay.
But when you factor in everything else, accounts payable, deferred taxes, operational commitments, Total liabilities stretch all the way up to $262.33 million.
That is a huge jump.
It is.
Yeah.
Compare that to their total equity, which stands at $303.78 million.
So technically, the assets do outweigh the liabilities, giving them a debt-to-equity ratio of 1.05. I always think of a debt-to-equity ratio of 1.05, like looking at a homeowner who has $1 million mansion, but they also have a $1 million mortgage.
That's a great way to put it.
Right. Sure, the asset on paper is massive, and technically their net worth is positive, but all of their available cash flow is going straight to the bank just to keep the lights on.
Which leaves them highly vulnerable if they suddenly lose their job, or in this case, if global silver prices suddenly drop.
That tension between the massive assets in the ground and the heavy financial burden required to extract them is exactly what is splitting the market right now.
Oh, completely.
It leads us perfectly into the great valuation contradictions surrounding this stock, because I was looking at the valuation models from different financial analysts, and they are living in two completely different realities.
A massive split.
On one hand, you have Simply Walson running a discounted cash flow model, and they are estimating the stock is almost 40% undervalued. 39.8%, giving it a fair value of $10.87. But then you flip over to Guru Focus, and their models claim the stock is currently trading at a significant premium over its intrinsic value.
Right, meaning it's too expensive.
Yeah. I know discounted cash flow models can be tricky, but how do we get a spread this wide?
Well, it fundamentally comes down to how heavily a model weights the future versus the present. A discounted cash flow, or DCF model, is essentially a mathematical formula that tries to figure out the value of investment today based on projections of how much money it will generate in the future.
Right, it discounts that future cash back to its present value.
Exactly. Simply Wall's Kagas model is looking at the projected output from the mines, multiplying it by projected silver prices, and saying, hey, the future cash flow is going to be massive, so the stock is cheap today.
Okay, that makes sense.
But Guru Focus, on the other hand, is likely weighting the current debt and the historical cash burn much heavier. They are basically saying, we don't care about tomorrow's promises. Today's liabilities make this stock expensive.
So let's explore that future promise. Let's look at the bull case, the best case recovery scenario that actually justifies that $10 plus valuation.
Because the bulls do have some serious ammunition right now.
They really do. First, their production is skyrocketing. In the first quarter of 2026, they hit record silver output, 787,000 ounces.
That's huge.
That is a 76% year-over-year increase. They aren't just exploring and hoping, they're actively pulling massive amounts of metal out of the ground.
And we really have to talk about the quality of that metal. The high-grade asset discoveries they've made in Mexico and at the Galena Complex in Idaho are just staggering.
Yeah, I saw those reports.
They reported yields up to 4,896 grams per ton of silver.
Okay, let's contextualize that for a second for you guys listening, because the numbers can get blurry. In the mining industry, what is considered a normal high-grade yield?
Generally speaking, anything over 150 to 500 grams per ton is considered high-grade, highly profitable ore.
Wait, really? 500 is high-grade?
Yeah. So when you start pulling core samples that are yielding over 4,000 grams per ton, you are talking about an absolute anomaly.
That is insane.
It is incredibly dense, incredibly lucrative rock. It means you have to mine significantly less dirt to get the same amount of pure silver, which drastically lowers your extraction costs per ounce.
Okay, that is a huge point. And they aren't just relying on silver anymore either. They just secured a new critical minerals joint venture with US Antimony at their Galena Complex.
Yeah, the antimony deal.
Antimony is one of those metals most people haven't heard of, but it is absolutely vital for defense supply chains, military equipment, and high-tech manufacturing.
It's critical.
By extracting antimony alongside the silver, they are diversifying their revenue stream and placing themselves in a strategically vital sector that often gets government support.
Exactly. If you are a bull, you look this record production, anomalous high-grade ore, and a strategic critical minerals partnership, and you see a company transforming into an absolute powerhouse.
The future cash flows look undeniable.
They do.
But I have to push back here, and this is where we pivot to the bear case. Because no matter how much silver or antimony you pull out of the ground, if your corporate structure is crushing you, the retail investor is going to suffer.
Unavoidably.
We talked about that debt-to-equity ratio of 1.05. That implies they are highly dependent on external funding to keep the lights on and keep funding these massive, expensive mine upgrades.
Right.
If they're burning cash on overhead, where does the new money come from? It comes from the shareholders.
You are hitting on the exact mechanism that terrifies the broader market. When a company needs cash and traditional bank debt is too expensive, they turn to equity financing.
Dilution. It is the absolute boogeyman for retail traders.
Oh, without a doubt.
And it isn't just a hypothetical fear in this case. The company recently filed to sell 2.89 million new shares into the market.
Which is a massive move.
Now, for the listener, let's explain why that is so toxic. When a company issues new shares, they aren't creating new value. They are just cutting the existing pie into smaller slices.
Exactly.
If you own 10% of a company and they double the amount of shares in existence, you suddenly only own 5%. Your voting power drops and your claim on future earnings drops.
And the timing of dilution matters immensely, too. Raising capital by selling shares when your stock is trading at $10 is one thing.
Right.
But issuing millions of shares when your stock has just suffered a massive pullback and is sitting in the single digits, that is highly dilutive.
It hurts so much more.
It does. You have to issue far more shares to raise the same amount of capital, which punishes your long-term loyal shareholders.
This is exactly why retail traders get trapped. You see the headlines about record production, you hear about the 4,000 gram per ton silver yield, you buy the stock, and then suddenly the company issues more stock to cover their massive overhead.
And the share price tanks.
Because the market is suddenly flooded with new supply, despite the fact that the actual mining news was fantastic.
What's fascinating here is that this dynamic, the stellar production versus the threat of share dilution, makes America's gold and silver a textbook example of operational leverage.
Okay, that is a massive concept. Let's make sure we clearly define operational leverage for the listener, because understanding this is the key to understanding the entire mining sector.
Absolutely. So operational leverage refers to the ratio of a company's fixed costs to its variable costs. Mining is a business with incredibly high fixed costs.
Right, you can't exactly build a mine on the cheap.
No, you have to buy the land, build the mine, buy the heavy machinery, and pay your corporate SG&A overhead, regardless of whether silver is trading at $20 an ounce or $40 an ounce.
The bills stay the same.
Exactly.
Yeah.
Because those costs are fixed. Once the company breaks even, any increase in the price of silver flows almost entirely to the bottom line as pure profit.
Oh, wow.
A 10% increase in global silver prices might translate to a 100% increase in USAS's profit margin.
But the sword swings both ways, doesn't it?
It absolutely does. If silver prices drop by 10%, the revenue shrinks, but those massive fixed costs stay exactly the same.
So the profit vanishes.
That means profit margins get completely wiped out, and the company is instantly forced into a cash crunch, which triggers, you guessed it, more share dilution just to survive.
High operational leverage means the stock is going to act like a slingshot attached to a roller coaster.
Exactly.
So if the fundamental reality is this intense tug of war, who is actually winning right now, let's transition from the balance sheet to the actual price action. Let's look at the momentum and the order flow.
The charts usually don't lie.
Here's where it gets really interesting. If you want to know what the people closest to the company actually believe, you look at the insider activity.
Oh, absolutely.
On March 31st, 2026, right in the middle of that nasty March pullback, when the market was basically panicking, there was notable insider buying. Directors and senior officers, specifically Scott McKeehan and Tara Hassan, stepped in to acquire shares at prices ranging from $4.94 to $5.24.
That is a critical data point. Insider buying is universally viewed as the purest signal of confidence.
Right, because they have their own money on the line.
Exactly. Executives will sell stock for 100 different reasons. They're buying a house, they have a tax bill, they want to diversify their portfolio, but they generally only reach into their own pockets to buy open market shares for one single reason. They genuinely believe the stock price is about to go up.
But if the insiders are buying the dip, I immediately want to know who is taking the other side of that trade. Who is betting against them?
Always a good question to ask.
I saw the short interest was last reported at 3.58 million shares. When I hear millions of shares shorted, it sounds terrifying, but we have to put that number into the context of the daily volume.
Right. 3.58 million shares shorted simply means investors have borrowed those shares and sold them, hoping to buy them back later at a lower price.
Simple enough.
But to understand the true threat level of that short interest, you look at a metric called the short ratio, or days to cover. For US ANSA right now, the days to cover is sitting at just 1.2.
Let's explain the mechanics of days to cover. Why does that 1.2 number matter so much?
Well, days to cover tells you mathematically how long it would take for all the short sellers to buy back all of their borrowed shares, assuming the stock continues trading at its normal average daily volume.
Okay, got it.
A ratio of 1.2 is incredibly low. It means that even though there are millions of shares shorted, the stock trades with so much liquidity and volume every day that the shorts could entirely exit their positions in just over a single trading session.
So for the traders out there on Reddit or Twitter hoping for a massive sudden short squeeze that blasts the stock to the moon, the data suggests that is highly unlikely.
Yeah, the setup just isn't there.
There just isn't enough trapping pressure on the short sellers. But a short ratio of 1.2 does reflect that there was consistent, heavy institutional selling pressure dragging the price down throughout March.
Absolutely. So let's map out the battlefield on the charts to see where the momentum is shifting now.
Let's look at the levels.
In late March, the technical indicators were flashing a deeply oversold condition. But by mid-April, the momentum completely flipped and algorithms started flashing a strong buy.
Okay.
Let's look at the actual price levels. Immediate resistance, which is a price ceiling where sellers tend to step in and push the stock back down, is sitting at $6.98.
Right.
If it can break through that, the major psychological resistance is waiting at the $10 mark.
$10 is always a massive psychological barrier for retail investors.
It really is. People like round numbers. On the downside, key support, which is the floor where buyers historically step in to catch the falling knife, rests at $6.52.
Okay, so that's the floor right now.
Below that is a pivot point at $6.18, and the absolute floor is that March low of $5.80.
And the mathematical momentum indicators are actually backing up the story of a recovery. Let's look at the 14-day relative strength index, the RSI.
The speedometer of the stock.
Exactly. Think of the RSI like a speedometer for the stock's recent price changes on a scale of 0 to 100. Anything over 70 means a stock is running too hot, it's overbought, and it's due for a pullback.
Right.
Anything under 30 means it has been beaten down too hard and is oversold. Right now, the RSI is sitting at 55.81.
Which is considered neutral to bullish.
Yeah. It shows the stock has completely cooled off from the March panic, but it still has plenty of room to run before it gets overheated.
And we also have the MACD indicator sitting at 0.210.
Right, the moving average convergence divergence. For the listener, the MACD basically measures the distance between a stock's short-term trend and its long-term trend.
It's a great trend indicator.
When the MACD crosses above 0, it means the short-term momentum has officially overtaken the long-term drag. A reading of 0.210 is a clear mathematical buy signal indicating the trend is curling upward.
It is.
But wait, I have to call out a bizarre technical quirk in the data here because if you are using an automated screener, you might be getting tricked.
Oh, what discrepancy are you seeing?
A lot of the algorithmic technical summaries out there right now are stating that USAS is trading above its 50-day simple moving average of $8.38 and above its 200-day average of $8.19.
Oh, wow. Okay.
They're flashing this as a massive bullish signal, but we just established the stock closed at $6.55.
Right.
6 is mathematically lower than 8. How can these trading platforms be flashing a trading above the moving average buy signal when the actual literal price action completely contradicts it?
That is an incredibly sharp catch, and it highlights a major danger for retail traders who rely blindly on automated dashboard screeners.
They can be so misleading.
When a stock experiences extreme, violent volatility like USS, dropping from $10.50 down to the low single digits in a matter of weeks, the short-term price action becomes completely decoupled from the long-term moving averages.
It breaks the math.
Sometimes algorithmic data feeds lag. More often, they trigger false momentum signals based on the rate of change rather than the absolute price.
It's interesting.
They see the stock bouncing rapidly off the bottom and extrapolate a crossover that hasn't actually happened yet. It is a mathematical warp.
So, to be completely clear for the listener, the stock is currently below those long-term averages. It is technically still in a longer-term downtrend. Even if the short-term speedometers like the RSI and MASD are flashing green,
Exactly.
you cannot just trust a dashboard flashing a buy signal at you. You have to look at the actual numbers.
You really have to understand the context of the volatility.
Yeah.
But, despite all of this, the massive corporate overhead, the dilution fears, the warped technical indicators, Wall Street analysts are surprisingly uniform in their optimism.
They really are.
The consensus rating across the board from analysts covering the stock is a strong buy. The average price target is $9.75, which would indicate a massive 48.8% upside from the current price.
And A.G. Wainwright just reconfirmed that exact target on April 17th.
Right?
So what does this all mean? If you are a listener holding this stock, or you are staring at your brokerage app thinking about buying in, how do you synthesize this technical noise with the fundamental reality of the mining business?
It really requires separating the short-term noise from the long-term thesis.
Right.
Let's break it down by time horizon.
Okay.
In the short term, meaning the next few weeks to a month, this stock is highly likely to face consolidation. It's going to chop around sideways.
The market just needs time to digest that record Q1 production news and weigh it against the recent share dilution.
Exactly. And investors are also keeping a very close eye on macroeconomic factors, specifically whether global silver prices can sustain their recent record highs.
Because of that operational leverage we discussed earlier.
Precisely. If global silver drops, USAS will feel the pain immediately and aggressively.
But if we look past the daily chop and shift our perspective to the rest of 2026, the horizon looks entirely different.
It does.
The ultimate long-term bull thesis hinges entirely on execution by the management team. Can they hit their 2026 production guidance of 3.2 million to 3.6 million silver ounces?
That's the real test.
And just as importantly, can they successfully complete the processing hub at the Galena Complex without burning through so much cash that they have to dilute the shareholders again?
This raises an important question about market psychology. The long-term transition into a silver-dominant producer looks genuinely bright.
Yeah, the assets are in the ground.
The 4,000 gram per ton grade of the ore is phenomenal, and the critical minerals partnership is incredibly strategic. But the short-term volatility, the heavy operational liabilities, and the constant looming threat of another stock offering those are the exact mechanisms designed by the market to shake out impatient retail investors.
They are trying to scare you out of your position.
You have to have an absolute iron stomach to hold through a rebuild phase like this.
It's the operational leverage at work. The potential profit is going to be amazing if silver prices hold, but you have to survive the construction noise, the corporate overhead, and the temporary cash crunches first.
Beautifully said.
So, to summarize this massive fundamental tug-of-war Americas, gold and silver is caught right in the middle. On one side, you have stellar, record-breaking production growth and incredible high-grade asset discoveries.
And on the other side.
You have dangerous operational leverage and a heavily burdened balance sheet that leaves management with zero room for error. The ultimate trajectory remains incredibly uncertain.
If you want to know where this stock is truly heading next, you have to look underground.
Okay, what do you mean by that?
The broader market is currently fixated on the debt and the dilution, but the real catalyst, it's the specific drilling results from those newly discovered high-grade veins at the Galena Complex. How will those specific assay results fundamentally change America's gold and silver's valuation model in the coming quarters? That is the physical data point that could tip the scales permanently, proving whether this is a genuine turnaround or just a value trap.
That is the ultimate metric to keep an eye on. Remember, you guys, the stock market is essentially a mechanism for transferring wealth from the impatient to the patient. But you have to make absolutely sure what you are patiently waiting for is actually a value play, not a trap.
Exactly.
We really want to know where you stand on this. Drop your bull or bear case for USS in the comments below. Before you head out, do us a huge favor, hit that like button and subscribe to the YouTube channel so you don't miss our next analysis. Thank you for joining us on this deep dive, and we'll catch you on the next one.